Welcome back to the Financial Literacy Project, presented by the American Bar Association Tort, Trial, and Insurance Practice sections, along with Thomson Reuters. This is the second segment of the Understanding and Managing Debt module. In the prior video, we discussed what constitutes debt. In this segment, we'll cover some of the common sources of debt. Please read our legal disclaimer in full. In sum, these materials and any forms referenced are intended for educational and informational purposes only. Credit cards. After opening a credit card account, the credit card company usually gives you a set credit limit. Your available credit is reduced as you charge items to the card. This is one of the most common and expensive forms of debt. It can be secured or unsecured. There may be an annual fee. There's often an interest rate, and you should be sure to look out for late fees, over-the-limit fees, balance transfer fees, and even foreign transaction fees. Be sure to check for deals such as interest only, special rewards, and balance transfer specials. It is recommended that you pay off your balances each month, if possible. Only spend what you can afford, and look for cards with suitable terms that fit your lifestyle and your needs. Using more than 30% of your available credit is a negative to creditors. Payment history accounts for 35% of your FICO score, and credit history accounts for 15% of your FICO score. Bank loans. After you apply, the bank representative will review your credit score, your credit history, and your income. Then they will determine how much money to loan and the annual interest percentage rate for which you qualify. If you don't qualify on your own, you may need a cosigner, or you may need to secure the loan with collateral. No matter what, make sure you understand the loan terms and any conditions that apply. Payday loans. Payday loans are high-cost, short-term, and very risky types of loans. They are typically issued in denominations of $500 or less. They are repaid from the borrower's paycheck, and they're often made to those of us who have bad or non-existent credit. The lender will confirm your income, your checking account information, and deliver you cash on the same day. In exchange, the lender will request a signed check or permission to electronically withdraw the funds from your checking account. Student loans, federal versus private loans. Federal student loans are loans that are made by the U.S. government. It's important to review the interest rates and the repayment terms, whether the cosigner is needed, and the other obligations as well. There are direct, subsidized loans that are made to eligible undergraduate students who demonstrate financial need. These are used to cover the cost of higher education at college or a career school. There are direct, unsubsidized loans. These loans are made to eligible undergraduate, graduate, and professional students, but eligibility is not based upon financial need. There are also federal Direct Plus loans. These loans are made to graduate and professional students, along with the parents of dependent undergraduate students, to help pay for education expenses not covered by other financial aid. Eligibility is not based upon financial need, but a credit check is required. Borrowers who have an adverse credit history must meet additional requirements to qualify. Federal Direct Consolidation Loans. They allow you to combine all of your eligible federal student loans into a single loan with a single payer. Private loans are loans from private lenders such as banks, credit unions, a state-sponsored loan agency, or non-bank financial institutions. Home loans, also known as mortgages and HELOCs. A home mortgage is a loan given by a bank, a mortgage company, or a financial institution that is secured against real estate. The lender actually holds title for as long as the mortgage is in effect, and the lender has the right to foreclose on the home if the borrower does not make the payments. Fixed rate or adjustable rate mortgages are available. HELOC, also known as a home equity line of credit. A borrower can take out a HELOC if they have equity in their home. Equity in the home is the difference in the mortgage balance and the market value of the home. It can be a revolving line of credit, and it can allow the borrower to take out money against the credit line up to a preset limit, make payments, and then take the money out again. Car loans. You can use a car loan to purchase a new or a used vehicle. Be sure to understand the average percentage rate, the down payment terms, the loan terms, the monthly payment, the principal, and the total cost of the loan. Interest. Simple interest is calculated on principal only. You don't pay interest on the interest with simple interest. Compound interest is the interest rate on a loan calculated based on both the initial principal and the accumulated unpaid interest from the prior periods. Compound interest is interest paid on interest. Let's say you did some shopping on the first day of the month and spent $5,000 on a brand new credit card. Assume that card has a 25% APR on purchases that compounds daily, and your billing cycle is 31 days. The first step is to calculate your daily interest rate. Next, you multiply the daily interest rate by your average daily balance of $5,000. Finally, you multiply this by the number of days in your billing cycle, and that will give you this month's or that month's current interest charge. Divide the 25% APR by the days in the year. So 0.25 divided by 365 days in the year gives us 0.000-68493 as our daily periodic interest rate. Next, you multiply that number by the average daily balance. So that will be 0.000-68493 times $5,000, which gives us 3.4246573 per day. Then you multiply this by the number of days in your billing cycle to get your monthly interest charge. So you take the 3.42 number, multiply it times 31 days in the month, and that gives us $106.16 is our interest charge per month. At the start of this month, you would have a balance of approximately $5,106.16. If you were to make timely payments of $125 a month to pay off the interest, then refrain from charging more on the card, the balance would never go up or down. Paying more than your monthly interest would bring the balance down. Paying a smaller amount, like $25, means the balance would rise incrementally over time, and that's not good. It also means your payments would never reduce your principal. By paying more than your monthly interest charge, you can lower your balance, which also lowers the amount you pay in interest. You can see creditkarma.com/savings for reference. All right, that concludes this segment. We hope you now have a general understanding of some of the common sources of debt. In the next segment, we will cover credit or FICO scores, including the reason credit scores are important and how they are determined.